So today we're going to be talking about how it is that innovation and data can be used to really help improve financial inclusion. We're going to talk both about what we have done so far and also where we're going on this side. Now, some of you are familiar with VantageScore will understand that financial inclusion is something that's very important to us. It isn't just that it's part of our mission and values. It isn't also the fact that it's a key metric that we use as we develop new models or as we're looking at new data sources to use in our models. But it's also part of our whole team's DNA. It's one of those drivers, like why we want to get up in the morning and helps us sleep at night, is knowing that we're doing something to really help improve financial inclusion in the United States. So what we've seen here, as you can see, is that in the United States, the makeup of the population is evolving quite consistently and quite significantly, right? It's becoming more diverse. We are seeing more of the minority populations growing at higher rates than the white population. And as a result, we're seeing some states, for instance, like California, who's sort of ahead of this trend, where it's already become what's called a majority-minority state. And in fact, the data seems to be pointing to the direction that the country as a whole will get to that state within less than 30 years. So I think most of us can understand the concept, right? That with fair and broad access to capital, we have a better working society. But what we're seeing in the United States, and probably in other countries for that matter, is that there are large portions of the population that have been excluded. And that has a really big impact, not just on those people, but on society as a whole. So let's have a look at kind of how that sets itself in effect here, right? So many of these populations, as you see here on the top left-hand side, they don't have, even at the beginning of their lives, access to some of the traditional brick and mortar institutions that you're familiar with just because of where they're born or where they grow up. We see that as a result, number 2 here, 22% of African Americans and Hispanics don't have a conventional credit score. That's over a fifth. As a result, so many of them are having to rely on unconventional sources of credit when they need to borrow money. And as a result, you can see that they're having to pay so much more to be able to get those types of loans. And even when they are applying for traditional loans, you can see here on the bottom right that, for instance, African Americans are have the 2 times the rate of denial than of white applicants with similar qualifications. Small businesses that are black-owned, we see exactly the same pattern there as well. And let's look at the effect that has on home ownership, right? We see that home ownership, 72% of whites in the United States have home ownership, where it's a minority in the case for Hispanics of 42% or 39% for African Americans. Now, probably many of you, given that we're at a fintech conference, know that one of the biggest ways that wealth has been created in the United States over the last 100 years has been through home ownership. So not surprisingly then, on the last point here on the bottom left, we're seeing that as a result, there's a massive disproportionality between the wealth of whites versus other minorities. In fact, 8 times the net worth of the average white family, median white family, over an African American family as a whole. So we have been already taking quite significant steps in the direction to try to address this situation, right? So our most recent model that we launched back in 2017 is VantageScore 4.0. When we built that model, we kind of went back to the drawing board. First, we realized that we could probably use the data in the credit file a little bit better. Second, we realized we could probably used some new math, or some different math, right, to get more value out of this data, and we're able to include trended data. The result of that was that we got a much higher predictive lift, so that's why VantageScore 4 is about 5% higher predictive lift than other scores out there. But also, it's a much more stable score, as one of the key things we see in here for both consumers, and it's also frustrating to lenders, is when minor changes in the credit report causes large swings in credit scores. So with VantageScore 4.0, using the trended data really helped create a much smoother trend that was more proportionate in its movements with changes to the credit file. But finally, we realized that a lot of the conventional models were being far too restrictive in some of the criteria they were using for how they would score people. And as a result, we found that by really looking at that criteria more carefully and figuring out what's going to be really important and what has an impact on our ability to score people and for the predictiveness of those scores, we were able to include 37 million more Americans with our model than conventional models. And of that 37 million, 10 million score over 620. Here on this chart, you can then see how that breaks down in some of these different ethnic groups in the United States. So, actually, I'll go back quickly for a second. So one of the first things to realize for you in the audience here, as fintech companies and as lenders, there's already a pretty easy step that you can take to significantly increase your audience and help create a more inclusive environment for your financial products, and that is to change to a score that is just more inclusive, right? But we realized that there's even more that we can do than what we did for VantageScore 4.0. So on the next slide here, you'll see on the right-hand side are the typical characteristics on the credit file that credit scores use to calculate the credit score. And probably a lot of these make sense to you. If your payment track record, how well you're using your credit, if you're using too much credit, etc. The length of credit history, accounts, etc. So that's information today that's being used. But we wanted to actually get a better understanding of like, well, if we had a more perfect view of information, what would really give us the best insight to be able to score people more fairly? And we went and took a step back, and on the left-hand side, you can understand that income is probably one of the most important factors, not just the amount, but the stability of that income, where it's coming from, etc. Makes a massive difference. Your assets and liabilities, and your cash flow. So in an ideal world, if we were to try to make lending decisions or other financial decisions on individuals, we'd really like to have a good view across those three areas. And if you now look at the right-hand side again, where you see what's used today, you'll realize there's a pretty big gap. So what is it then that we can do about this situation? So we saw that, as many of you have probably identified, there are so many sources of alternative data that are out there, and a huge amount of which can probably have some impact on our ability to score consumers better or lenders better. But we started with what for us was probably going to have the biggest impact, and that was using bank account data. So your DDA checking account data, where we have it, savings account data, for instance. And so we went and created a new model based on using over 1 million consumer checking and debit account histories, as well as obviously what's on their credit files. And with that, we were able to create a scoring adjustment to our traditional VantageScore 4 model. So we found that not only did that adjustment for the checking account data have a big impact on predictability, it also had a massive impact on our ability to score more fairly consumers, both on the lower end of the scoring bands and as well as on the higher end of the scoring bands. So what you see on this chart here is the distribution of the scoreable population in the United States with VantageScore 4. So this is before we add checking account data. And the orange on these bar charts is the proportion that's newly scoreable. So as I mentioned before, with VantageScore 4, 37 million more consumers, and about 10 million of them fall above 620. Now, we have to realize that, yes, we're able to score a lot more consumers, but we still don't have perfect information on them, right? And so there's definitely an opportunity to improve how many of these consumers can be eligible for products and better pricing. So when we looked at when we put our model into effect, one of the things that was really important for us to understand was how many consumers was it scoring up and down versus VantageScore 4.0. And we saw some really fascinating results here, right? So we saw, for instance, in subprime, that close to 20% or 18% of the consumers in subprime got a score increase of over 20 points. In near prime, it was over 30% of consumers got a score increase of over 20 points. So as you can imagine, for many of those consumers, that meant that they were now eligible for products they weren't eligible for before, or a higher amount of a credit limit, or a larger loan, and definitely better pricing. But you'll also see here that this also moved some consumers down. Because guess what? The checking account information doesn't just inflate everybody's scores, and that's definitely not what lenders want or other fintechs want, right? What it is doing is it's re-ranking the whole population now using this checking account information to reorder based on the rankings. So we also see a number of consumers being ranked downwards as well. So that would tell you that there are always going to be some consumers that actually, once you include the checking account data, may actually have a worse position than you would have seen if you just looked at their typical credit file data. So a big impact here again. Let me just touch on that again. So we saw with VantageScore 4, we see about a 5% increase in predictive power over your conventional scores, the better known ones out there. But then on top of that 5% increase, in some of these core categories like subprime and near prime, using checking account data, we see an additional 6 to 10% predictive lift. Now, you don't have to be a super math whiz, and despite those jokes before, to realize that that is a really, really big lift. So we've covered quite a bit in terms of what these scores, what we're trying to do. So we first created a model. Actually, I'll go back for a second. We first created this model 4.0, which allowed us to score many more people. And then with the checking account data, we're able to get much more accurate views on those people that we're now scoring, right? And we're seeing that this can really help lenders and fintechs in situations like a second look, where somebody didn't first qualify for a particular financial product before, but now using this data, you can evaluate whether or not they could qualify or not. Or for looking at other situations where having a little bit more due diligence would be really valuable for making those credit decisions. Now, with that, as I said, we've covered quite a bit, but I'd also like to summarize some of the key findings or takeaways from what we've found so far in this research and in our multiple conversations with lenders and fintech companies. So on this first slide here, you'll see that obviously the truth is there are a lot of challenges with conventional credit scores. As I've touched on already, they're less predictive, right? They're not incorporating some key data points that will really make it much more predictive and much more fair. We're seeing that they're often exclusionary, right? Because they are disproportionately affecting minorities of people who don't have traditional access, right? Some of you know the credit scoring catch-22, right? And at least when I migrated to the United States, I definitely felt this, right? Which is that you can't get access to credit if you don't have a credit score. You can't get access to a credit score, or you can't get a credit score if you don't have a credit history. And you don't have credit history unless you get credit, right? It's a little bit of a preposterous circle, right? But it is the reality of how the system works. But including additional data sources can really help break that chain. So the third piece here, we also saw that obviously, as a result of these issues, many people are having to pay much more for their, in terms of lending costs, than they otherwise would if there was better transparency. And finally here you'll see that that has a disproportionate effect on those in lower socioeconomic backgrounds and new immigrants and minorities, really creating an even bigger barrier to social mobility. But there are lots of good things to take away about the current situation. I think there's a bright future. I'm not really that much of a pessimist. I'm from Sweden. We're pretty happy people, right? So what we see is that we can, by make things much more fair and increase the scoreable population, and also use additional data sources to really improve fairness across the US population. We can get much better performance lift, as I mentioned. 5% performance lift with VantageScore 4, and then an additional 6 to 10% predictive lift by using the cash flow data for the scoring adjustment. Thin files, we see that we have a massive opportunity to improve the credit scores for those that have limited information on their file and therefore getting low scores, not because they've done anything bad, but because there just is too little information on file. Obviously, we can create access to millions more people to financial products at good prices, so they've got a better chance in life and they can better contribute to the economy. So in all, as we've spoken with lenders, with fintechs, with consumers, this is clearly a win-win situation. Not only does it benefit consumers, but lenders as well are going to significantly be able to increase their addressable market and improve their ability to determine what the likely default rates are going to be for consumers as you have more predictive scores. So thank you all for listening to my presentation. I'm sure you'll have a few questions. Thank you again to Finovate for letting us present today. If any of you have questions for me and the team, we will be down at the reception at the cocktail hour straight after this, so don't hesitate to grab one of us at VantageScore, or in case you're not able to gather us there, please don't hesitate to reach out to us on our website or email us if you need to. We'd love to hear from you. That's always important for us to hear directly from you. So thank you so much.